Economic activity in Kenya continued to expand in March, but at a slower pace than in the month of February. The slowdown was driven by rising inflation, which resulted in subdued demand growth by consumers, as well as a contraction in output by producers. Both input and output prices rose at record rates, driven by higher taxes and the Russia-Ukraine conflict. Farms increased their stock of purchases in anticipation of further increases in output prices and ramped up the employment levels to support the slightly higher demand. In light of the rising inflation, the 12-month outlook as reported by farms fell to the lowest level since the start of the survey. Hello, my name is Kuria Kamau. I'm the economist here at Stanbic Bank Kenya. And today, I'm here to talk to you about the Stanbic Purchasing Managers Index, the Stanbic PMI as we like to call it. The Stanbic PMI is a monthly indicator of business conditions and is carried out by surveying 400 of the largest companies across various sectors and asking about business conditions in that month vis-a-vis the month before. How you should understand the reading is any score above 50 indicates an expansion in business conditions, while a score of below 50 indicates a contraction. If we focus on the March report, the PMI reading fell to 50.5 from 52.9 in the month before. There are four key things worth highlighting. First is, both export and domestic demand appear to have been impacted by the Russia-Ukraine conflict. While inflationary pressures from the conflict resulted in marginal growth in domestic demand, they contributed to a decline in export demand. Second, farms increased the quantity of purchases, which boosted their stock levels higher in anticipation of a further increase in input prices and potential shortages. In addition to this, they ramped up employment levels to support the slightly higher domestic demand that was witnessed. Third, both input and output prices rose at a record rate. Input prices in particular rose at the fastest rate in the last 8 years, driven by higher taxes and the Russia-Ukraine conflict. The Russia-Ukraine conflict resulted in higher fuel costs, higher food prices, and as well as an increase in fertilizer raw material costs. Output prices, meanwhile, rose at the second fastest rate on record as farms tried to protect their margins. Finally, while most businesses remain positive about the output over the next 1 year, the concerns around rising inflation have pushed the future output index to the lowest level since the start of the survey. Looking forward to the next PMI reading, the key things that are worth highlighting continue to be inflation and the potential impact of the Russia-Ukraine crisis. The recent rise in inflation could negatively impact farms' ability to produce and consumers' ability to consume as much as they've done previously. While trade between Kenya and Russia isn't too significant, the sanctions that have been imposed on Russia continue to cause a rise in commodity prices, in particular oil, wheat, and fertilizer prices. That's it for now. Until we meet again for the next PMI reading, we at Stanbic Bank will continue to support you and your business with market-leading insights, because Kenya is our home. We drive her growth.